So what is the outlook for the banking sector in 2017? It may surprise you, but banking shares were amongst the better performers of 2016, despite the huge obstacles placed in their way. Ratings agencies, of course, continue to lurk on the sidelines, despite the president saying it's all just pessimism and perception. In a recent note, Moody stated that banks need more liquidity. And on the local front, investigations into apartheid-era bailout at ABSA being investigated by the Public Protector, not to mention the Financial Intelligence Centre Amendment Bill, which, if not signed into law, could make South Africa, in terms of banking anyway, a global pariah state. That's cheerful. This is The Moneymakers. I'm Bruce Whitfield, and tonight I'm joined by the Korner Perspective Director, Graeme Korner, to discuss how South Africa will navigate what is a challenging year ahead. Now, this time last year, Graeme Korner, if I had said to you, you know what I think we should do, Graeme? I think we should buy some bank shares. You would have phoned people at our local asylum and said, please bring a white coat and take Whitfield away and lock him up. We'd just come through Nenegate. We were in the throes of depression. The currency was collapsing. Inflation was spiking. Banks were the last place to invest money. Yet they had a spectacular 2016.
Well, if you'd wanted to do that in December with Nenegate and early in January, early in 2016, we would have to be committed with you, because we were also buying them. Because we took a view that the South African banking sector is very, very well run. It's largely funded by South African money. One of the best banking infrastructures in the world, in fact.
Don't we rate where? I mean, there are lots of different rankings, but we're in the top six or seven or something.
It's incredible, yeah, and that's one of the reasons, obviously, why we pay exorbitant bank charges. But if you think we've got 4, if you include Investec and Capitec, 6 really state-of-the-art, very well run, very well capitalized, technologically sophisticated banks. So, yeah, unfortunately, we can't say the same for our education system and certain other areas.
That's what's so interesting about South Africa, though, is we don't have a great pool of customers who are going to make the banks rich. We have a small pool, we have a small corporate environment, we have an African continent into which many of these banks are moving, and they perform strongly. They've got really strong returns on equity, which shows their profitability is good, and they sit on lots of capital.
Yeah, and capital, I think, is the key, because if you're saying, well, you know, we might get a downgrade can hurt them in a number of ways. Firstly, obviously, appetite for the stock, but most importantly, then anybody with an investment grade mandate will not be allowed to put money with them, and depositors also will be fearful. So I think that is the context, and obviously the reaction of the banks will be to, as I think they've been doing, in spite of what Moody's was saying. I think they've been working very hard to lengthen the duration of the deposit book just in anticipation of this. And every time we get a reprieve, of course, then, you know, there's a nice sigh of relief. But I think the banks have been working hard to lengthen the deposit book for 2 reasons. One, I think they're saying, well, we might actually be quite close to the peak of interest rates, so let's lock in rates higher up. You know, for longer at these levels.
I was chatting to Sid Vianello the other day, the retail analyst, just talking about the fortunes of the retail sector. And he thinks the retail sector has hit the bottom and is on the way up. Also because inflation, he believes, has topped out, better rainfall, better commodity prices, healthier, economically anyway, South Africa in 2017 and 16.
Yeah, and the rand doing a little bit better, courtesy of Mr. Trump. So I think when you look at all of the things combined, and I've been quite pessimistic on inflation in South Africa for some time, and I think I've been proven correct, that we sort of stubbornly
very sticky
around 6. But you know, we could actually, it doesn't take a hell of a lot, maybe not on a 1-year view, but go forward 18 months. You have a wonderful crop, and Grain SA, I think, was talking about that. Who knows? You know, there's a hell of a lot of bad news priced into the maize price. Obviously, the rand has been hit, so I can see inflation quite easily moderating, in which case the SARB doesn't really need to do too much. But what I was saying is the primary reason I think the banks have been bolstering their longer-term deposits is just so that if there is a downgrade or, you know, a systemic shock, that they say, well, we've got the liquidity. But from a capital point of view, I think Standard Bank is running a Tier 1 common equity capital adequacy ratio of 12.5. I've been critical of that and said it's way too much.
I mean, you would say it's lazy capital. They should be returning that to investors, but it's an insurance policy.
It's an insurance policy. So again, it's, I think, an indication of just how well run the South African banking scene is. And all of them are running very, very high capital adequacy ratios. So, yeah, look, I mean, clearly a downgrade would hurt, and I think it would hurt the whole economy. It would sort of send us into a bit of a tailspin. But we've seen other economies around the world get that downgrade, and things carry on. I think also quite importantly is the South African banks have licked their wounds and come away from London and other parts of the world, but effectively they are really principally South Africa focused, and then some of them principally Standard Bank and Barclays Africa, with very nice operations in some of those big growth markets.
And one then has to say, have they called the cycle right in terms of going from challenging capital intensive global operations, coming home to the African continent just at a time where commodity prices dipped, just at a time where the oil price collapsed, and big exposures to the Nigerias of the continent, the Angolas of the continent, oil dependent economies, which are now flagging and really, really struggling?
Well, yes and no. If you take a 1 year view, you'd say, well, that wasn't really smart. But if you take a 20 or a 30 year view, you'd say, well, a lot of people are very excited about the African continent. I tend to agree with that hypothesis. You look at a lot of economies in Africa, even those that have a fair commodity exposure, they're still growing, well, let's be honest, a whole lot better than South Africa. In markets like Kenya, Ghana, even Nigeria, this too will pass. So I think the move into Africa makes a whole lot more sense. There's less competition, and I think you can almost service it from a South African hub to a large extent.
But you seem to be implying, though, despite all of this great news and all of these great prospects and the anticipation of riches to come over the next 20 or 30 years, that now's not the time to be adding to banking share portfolios, because this time last year was, well, in retrospect, it's obvious, and you did put some money into banks, but you're not adding any more right now.
No. And I think the view we would take is you're looking at pretty anemic earnings growth. If you look we've still got to get 3 of the 4 will release for December, and one's going to give us half year numbers. You're probably looking at 6, 8, 10, maybe 11% earnings growth. That's not spectacular. Dividend yields are very good. 4.5, 5 forwards of some of them almost 6%. And again,
why wouldn't you take that?
I think the point for me is that if we could pull a chart, say, of a Standard Bank or a Barclays up, you'll see just how volatile it has been. So if you're saying, well, maybe there's a 30, 50, 70, whatever odds you want to put on a downgrade of South Africa, then you don't want to go and buy a Standard Bank at 150 Rand. You'd say, okay, well, it's fair value. Our estimation is that's what it's worth. But we'd rather buy things at a discount to intrinsic value rather than just chasing it. Because right now, I think if you pay these prices, these are sort of the long run PEs, and all you're going to get is the earnings growth, which is pretty lousy if you look a year or two.
What odds are you putting on a downgrade?
I think unless we get our house in order quite quickly, it's probably a 50-50. I think we've got a stay of execution, but the ratings agencies have been rumbling, and I think some of the state-owned enterprises are also adding to that angst.
I agree with you that there's angst, but I also am frankly relieved and surprised that we've been given the passes that we've been given, and those passes have given us an opportunity to get that house in order. What do you read into Cyril Ramaphosa going to Davos rather than Jacob Zuma? Is he simply getting his enemies out the way while he repositions the deck chairs on the Titanic? Or is this actually South Africa treating the World Economic Forum, treating the global environment a bit more seriously?
Well, he's deputy president. I suppose a person can only be in one place. But I think if you look at Cyril Ramaphosa taking control of the state-owned enterprises that were a problem, I think a lot of people feel the economic portfolio is logically his. So I don't read much more than that into it.
But that's a positive.
That's a huge positive.
And that's a ratings positive scenario.
Yeah, but then of course we're still scoring own goals. We haven't signed the FIC legislation in, and we've still got the political rhetoric and what seems to be quite a lot of infighting within the party.
Quite a lot of infighting. Now that's the understatement.
Yeah,
that is it's 12 minutes past 9 at night, and that is the understatement of the day so far. You win.
Yeah, but I think so. We've got a lot of challenges, but I think people like Pravin Gordhan are doing the very best they can to not only avoid a downgrade, but to keep South Africa on the agenda. And I think the big banks in South Africa have done a lot for that as well. In fact, I think if I look at some of the commentary and almost how the corporate community was standing behind the Minister of Finance, I think that thrust actually came from the banking sector, and shows character and courage to me. So I think we've got good institutions, they're well run. all we've got to do is just sort some of our nonsense
Stop
out.
messing it up.
Yeah, basically.
Scientifically, if we get really sum it all up. So, is there any banking share that you would put money into right now? We've got the world's best bank, according to whatever research it was, Capitec. It hit $700 the other day. It's been expensive ever since it started at R2 a share. Then you've got Investec, which is pretty neatly rated, but it's got Brexit worries hanging over it, and it's got a big UK business and the asset management business there. The big four banks are struggling. I mean, the most attractive PE is Barclays Africa, but then it's got a shareholder that controlling shareholder that doesn't want it, and it's got a R2.5 billion bill potentially hanging over its head, courtesy of a 20-something-year-old bailout, courtesy of the apartheid state.
Yeah, but this stuff, I don't attach much value to it. I mean, it's 20 years old. I think this thing was flagged in the early 2000s, and nothing happened. So eventually, you say, well, I'm a current shareholder. I wasn't a shareholder of ABSA way back then. Why should we be punished for that? But the point you make about Barclays wanting to exit Barclays Africa is a great one, because
and Old Mutual had a Nedbank.
Absolutely, but what you've got is four banks, all with strong shareholders of reference. Whether they are willing shareholders of reference or not is a secondary point. But you've got ICBC, which is a giant backing Standard Bank. You've got the Remgro stable backing FirstRand. Of course, Nedbank has got Mutuals backing. So as far as I'm concerned, and even Barclays, whether Barclays PLC wants to or not, they are the shareholder of reference, and capitalization or funding is needed, they are there. So I don't see that as a huge worry. I don't think anybody's going to rush out, because you've also got to satisfy the regulators in South Africa, who are also good. Let's give credit there too. They're not going to let some thinly capitalized private equity fund come in and say, well, we're going to buy the 50% of Barclays Africa, and maybe we can plug a hole if there ever is one in the capital or the liquidity. So all round, they are solid, they're stable, they're going to give you anything from 5 to 10 to 12% earnings growth over the next 2 years.
What's going to do better?
Well, it's a good point. In the market, what is going to do better? Not much. But I think on balance of arguments, I'm saying if there is a 50-50 or a 30-70, whatever odds you want to put on it, risk of a downgrade, just wait. You might just get Standard Bank at 125 Rand. You don't have to pay 150. Then you've got a chance of making money. Otherwise, all you're getting is a decent dividend yield, and let's call it inflation earnings growth.
There we go. Graeme Korner, thank you. Korner Perspective Director Graeme Korner, with his perspective on South African banking shares. More issues to talk about, more investment opportunities, and more things to avoid next time on The Moneymakers. Till then, bye-bye.